2 months ago, I sold a covered call in an AI company. It then went on a 14% run. I did that covered call in OpenText because I wanted the covered call income, but I also wanted to benefit from the AI rally. In this video, I'm going to show you how I manage covered calls in AI companies like OpenText without capping the upside too early. Before I do that, let me ask you, are you doing covered calls in AI stocks? If so, which ones? If you're not, what's preventing you from doing covered calls in AI stocks? Let me know down in the comment section below. It's my very strong belief that AI isn't just hype. The world has shifted. AI is here to stay. Things have really changed, and therefore our thinking of the companies that we're investing in should also be changing. I'm not saying you should stop investing in those boring, stable, consistently profitable companies. If you're not already investing in AI companies, you might want to add some to your portfolio. Just make sure they're good, solid, profitable companies. And here you see one I believe fits that test. Stocks like OpenText, they're AI companies, but they also offer a dividend. They actually offer a pretty good dividend. Their dividend is right at 3.64%. So we got AI, we got dividends, we got covered call premium. This strategy of selling covered calls and dividend AI stocks, it lets you not only benefit from potential AI stock price appreciation, but also get paid while you wait. Because you're continually collecting that income, you're also decreasing how much you have at risk. So how exactly do you do this? How do you sell covered call in these AI stocks that can really move around a lot? Now I'm going to show you the entire process I go through when I sell covered calls in these high growth AI stocks like OpenText. First, let me give you a lay of the land or all the background information on this OpenText position. On May 3rd of last year, we were assigned the $35 strike price put options. As a result, we bought 600 shares of OpenText at $35 per share. Here's what the chart looked like on that day. Now at this point, I believed OpenText was pretty undervalued. So I was comfortable owning these shares that had been assigned to me. Now I've adjusted the chart so you can see up to almost today. This is the day we were assigned these shares back in May of last year. And this is where we're going to pick up our discussion on this covered call in OpenText. During this time frame, as you can see here, OpenText continued to drop in price. It did meander up and down some, but overall it dropped in price by about 14 or 15%. Now during this whole time, I was trading covered calls in OpenText. But at this point, I believe OpenText was really undervalued. So I wanted to position myself to benefit from some stock price appreciation if OpenText went way up in price really fast, but I still want to collect some nice covered call premium. Although I have been selling covered calls almost this whole time in OpenText, notice that on February the 21st, I allowed that February $35 covered call option to expire worthless. So I received $1.82 per share for it, and it was worthless on that day. In this yellow area here, that's the day I let the covered call expire worthless. You see, I was trading at an area that I thought it might find support because it had found support here, and then also back in here. So I thought it was possible that we might experience a nice bounce here. However, that didn't happen. It did continue to decline over the next month. And after coming down and forming a new lower low as well as lower high, when it found resistance at that green 50 moving average and came down and made a new lower low, I decided that next time it came back up to that green 50 moving average, I would sell a new cover call. And that's what I did here. On April 15th, I sold the August, so 4 months to expiration cover call option. I sold the $30 strike price. I got nice premium of 56 cents per share. So what does this set me up for? How does this help me out? Well, first of all, I just lowered my cost basis by 56 cents per share. So that's great. Although the stock's declining, I'm continually lowering my out-of-pocket costs on the shares I own. And it also paid me in another way. Since I was in a covered call and I owned 600 shares of OpenText, it allowed me up to receive this dividend. You see, OpenText was going ex-dividend on June the 6th. And the dividend on this AI stock is pretty good. It's currently at 3.64% or 26 cents per share. So I was very happy to receive that times the 600 shares that I owned. So here's where we're at. It's April 15th, and I've just sold the August 15th $30 cover calls and got 56 cents per share. What was my thinking? Why did I do that? Let me show you on the charts. On this day, OpenText was trading for around $25 per share, but it was approaching an area that I thought it might potentially find resistance because that green 50 moving average had generally been serving as resistance for it going all the way back to the previous winter. But in spite of that, I want to give myself some room for the stock to possibly go up in price, which would enable me to benefit from stock price appreciation and pocket that cover call premium and collect the dividend. I noticed that we have resistance right here around $27 per share. And I felt pretty strongly here, as you see as I zoom out in this chart, that the red 200 moving average would probably serve as resistance for OpenText if it got there. And on that date, the red 200 moving average was around $29 per share. Because of those two potential resistance points, I decided to sell the $30 cover call option. I would have to be in this through an earnings announcement, but I liked that I was giving myself about 20% for the stock to run up before my cover call was challenged. And I still got pretty decent premium of 56 cents per share, coupled with that dividend I was going to receive. But did I do the right thing? Well, let's recap here. We're in a downtrend, so that was my only concern, and I probably would have sold it at the money $25 cover call strike price. But that wasn't my only concern. I know AI is real. I know this company should benefit from AI if they implement it properly. I firmly believe the company is very undervalued at $25 per share. So instead of selling it at the money cover call, or maybe even one slightly out of the money around 27.5, I decided to sell that $30 cover call. I could have sold it even higher if I went out farther out in time and still collect a nice premium, but I thought a 20% move was sufficient for the next 4 months. You see, I had plenty of resistance points in between where OpenText was trading at and that $30 strike price cover call. Remember, we sold the August 15th $30 cover call. When I just asked Siri, they told me today is Sunday, June 29th. So you see where we're at. We still have about a month and a half before this August expiration expires. But more importantly, here's where I'm at with my overall position. Notice I've collected dividends multiple times in these shares that I own. I really like that. I've also sold multiple cycles of cover calls. I really like that as well. And since I have position sizing available, I've also been selling some far out of the money additional cash secured put options just to help overall lower my out-of-pocket costs for these shares. Because of all this option premium and dividend collection I've done over the past year, even though I had to buy the shares at $35 per share, my overall out-of-pocket cost is $31.50 per share. And that's for the 600 shares that I currently own. Now understand, I believe it's still very fundamentally undervalued. Well, where's the stock at today? Now just remember, we sold that August 15th $30 cover call strike price. And as of Friday, June 27th, the stock was trading for around $29 per share. So just out of the money on our cover call. Will it push through there? Well, I don't know. It's been trying now for going on about 2 months. So we'll have to see what happens. I still have about a month and a half before my cover call expires. But there is a bit of a wild card because it does announce earnings on August 7th. So we'll have to see what happens through earnings. But if I need to roll my $30 cover call strike price up as I roll it out again, I can sell some additional cash secured put options to help fund rolling that cover call strike price up. And just so you know, my opinion, and take that for what it's worth, it's just my opinion, I believe ultimately OpenText is a $50 per share stock. So I believe that as long as nothing fundamentally changes with the company, it's still potentially very undervalued. In fact, undervalued by around 40 to 50% in my opinion. Please don't take my word for it though. Do your own research. It's just my personal belief. So I would like to work this position. If I end up being able to own these shares all the way up to 50, well, that'd be awesome. But one thing I do know, by selling cover calls in this AI stock, I'm continually lowering my out-of-pocket cost or my cost basis in the stock. And if at any point I just want to own the stock, collect the dividend, and benefit from potential stock price appreciation, I can just close out my cover calls or let them expire worthless. And if my cost basis gets low enough, I just might do that. So we'll see what happens. So by way of recap, how should you handle cover calls in these volatile AI stocks? Well, the first one in my opinion is trade in fundamentally undervalued or at worst fairly valued companies. Then if you think the stock is going to go up in price, try to sell out of the money cover call options. Don't sell them at the money unless you think the stock's going to kind of trade sideways or maybe trade down a little bit. If you want to benefit from stock price appreciation, sell them out of the money. And preferably at 1 or 2 resistance point above where the stock is trading at. Then consider selling them around 60 days to expiration. That gives you a chance to collect some nice premium, but also not too far out in time, which might mean you might miss some of that stock price appreciation. I know a lot of traders like to pick their strike prices by delta. I don't think that's a good idea. I personally believe you should pick your cover call strike prices based on resistance levels. And one more thing to keep in mind on these AI stocks that pay a nice dividend like OpenText is keep an eye on the ex-dividend date. If the cover call is in the money, there's not enough extrinsic value, and you don't want the stock called away from you, it's time to roll that cover call out so it's not called early. If you'd like to get an alert whenever I buy a stock or sell options, check out the benefits of becoming a Patreon down at the link in the description below. Goofball333, I love the name, and it's a supporter and a viewer here on YouTube asked what I thought was a really good question. They were in a cover call that's gone deep in the money, and they asked for some help on how to fix or adjust that position. If you'd like to see how I adjust my cover calls or poor man's cover calls that have gone deep in the money and I don't want to lose my shares, check out the video at the link above and the description below entitled, Don't Lose Shares to Assignment, Roll Like This. Until next time, happy investing, and we'll see you again soon.